Hello and welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Ritu Singh. And Ritu, finally you can see some Friday cheer on the markets after a quiet flat start. It's picked up for the markets, up 0.5%, the Nifty inching towards 25,600. And what's helping is, one, banks. Banks continue to outperform. So this week, while the Nifty has gained about 0.5%, the Nifty Bank has outperformed with a gain of 1.5%. And the IT index, which opened with a loss of 1%, has erased all the losses and now trying to get back into the green. So that is helping. And the advanced decline ratio, though, is now in favor of the gaining side. So that's positive. Hi.
Hi, Reema. It is positive above 1.16:1. That's where we stand. So the market breadth very much positive, and the bank Nifty doing its job, although the IT index is seeing some pressure today. But, interestingly, there are some names like, GMDC pulled that up on the back of the Pax Silica, signing that just happened. You're seeing names like that perk up in trade. Data Patterns, Tata Invest. You also have Siemens. That's making some smart recovery that we can see, for now. But, almost every other index is in the green, barring IT and the Realty and Pharma pack, which still remain a bit of a drag on the markets. ICICI Bank, Reliance, these are some of the heavyweights that are lending their support to the markets in today's trading session, while Infosys, Eternal are some of the stocks on the downside. But Reema, we're focusing on some earnings that continue to come, and ABP India is one of them.
Indeed, and we've got Vinny joining in the studio to talk about the Q4 numbers and the way forward. Vinny.
Hi, yes, so ABP India, the stock is buzzing away in trade. Inline set of numbers that's coming from the company. Order book, that's been good. 4,000 crores approximately is the order inflow in the quarter that has gone by, Q4 calendar year 25 for them. So 4,096 crores to be precise. Order backlog now stands at around 10,471 crores. And the company has highlighted that they have benefited maybe from orders from data centers, automotives, building, infra, rail, as well as the metal segment. So overall, the order inflows has jumped up by 50% on a year-on-year basis. Apart from that, this time in terms of revenues, that has seen a growth of around 5%, in line with what we were expecting. Margins have come in at 15% versus 19% in the same period last year. But if you exclude the labour code impact of around 66 crores that's come in this time, then the EBITDA margins would see a better jump, that is 17%. Overall, even in terms of flows, order inflows, they've been much better than what we've seen in the last few quarters. Overall, in the first half maybe of this calendar year, the company had seen a bit of a tepid performance. Now we're seeing a bit of an improvement that has come in for the company. Do not forget, in terms of the numbers that came in from ABB Global, we had an indication in terms of the order book or where it would stand at or the jump that we would see. And that time also in January, the stock had seen a jump up. And in the last 1 month, the stock has gone up more than 20%. Today, after the numbers, also a good run-up is coming in for the stock. The trajectory of the company going forward is the key. But as of now, good numbers across all segments they managed to do well. And that is keeping the stock a buzz.
All right, Winnie, thanks very much for taking us through that. The other, sort of stock that is in focus is PB Fintech. Now, that surged by almost 3% as we speak because of an upgrade that's come in from Kotak Institutional Equities. Sudarshan has been, looking at the details of that note coming in from Kotak and joins in now. Sudarshan.
So in the recent past, the stock of PB Fintech or say Policy Bazaar has been underperforming across the sectors. And the reason is the concerns that company faces is the regulatory concern, and IRDAI may come out with a consultation paper related to commissions, and that's one of the reasons why the stock has been underperforming. Now today, Kotak Institutional Equities has come out with a note upgrading the stock to add from reduce. It's a double upgrade and maintaining the target price of around rupees 1,725 per share. Now, what it's saying the risk reward after the recent underperformance has turned favorable. And second, the concerns that company faces from commission draft paper that IRDAI may come out, that may be offset by the tailwinds that company has from the term and health insurance premium that has been seeing the healthy growth. In Q, the calculated commissions rate was healthy at 21 to 22% in the last 4 quarters. Premium growth in Q3 was up 45% versus 35 to 39% in the last 3 quarters, and 70% growth was seen in term and health premium, which comprises almost half of the PB Fintech or say Policy Bazaar's business. Now, Kotak Institutional Equities does not expect Q3 momentum to continue, but it may remain over. Premium growth may remain over 40% until FY27 and 33% in FY28 versus company's medium-term growth of 30%. So, Kotak Institutional Equities believes that the growth that they are expecting in the premium, especially on term and health, and the tailwinds that the company is going to get from this may offset the concerns from the commission charges.
Thank you very much for that. Innocent Bank also is reacting to a brokerage note coming through from MK. What does it say, Ritu?
Well, MK has upgraded Innocent Bank to buy from a reduced call and also raised the target price by almost 38% to 1,100 rupees. And this is on the back of what they call reinforced confidence in the new management's push on fixing some of the structural gaps in the bank, whether that is reorienting the asset liability mix, strengthening the governance controls, and also rebuilding leadership. Now, MK believes that this is going to set the stage for a sustained turnaround for the bank. Remember, they've just turned profitable after reporting a loss in the second quarter, and the management is guided for in-line credit growth for this time around and an exit ROA of about 1% for FY27. Now, MK believes that the ROA will further improve to about 1.3 to 1.5% by FY28-29 from the low of 0.1% that we're going to see in this current fiscal because of the growth, asset quality, recovery gains, all of that add further traction and drive a stock re-rating. Beyond this, MK says there could be a reorientation of the asset liability mix towards consumer retail, and that is also going to help the bank deliver a healthy, sustained risk-adjusted return on capital. MK also says that the improving sectoral tailwinds and the favorable sentiment towards large private banks should further aid in Innocent Bank's re-rating, similar to what we saw with Federal Bank. And it also adds that for any further re-rating, it'll be dependent on sustained execution of the management strategy and no surprises on the asset quality or regulatory front.
All right, we'll slip into a break on that note. On the other side, we'll discuss bond markets with Manisha Gupta. Stay tuned.
And India Bonds presents Bond Street.
Welcome to Bond Street. Joining us on the show today is Vijay Chandok. He's MD and CEO at NSDL. Mr. Chandok, hi, thank you so much for joining in.
Thank you.
And the way the markets seem to be performing right now, what would you say is the driving factor for increasing retail participation into the debt market? In the last couple of years, the numbers have been quite strong. And there is this certain push now, starting right from Nifty Aayog report to budget mentioning debt market. And then, of course, SEBI's also done an outreach program. Would you say the time is right or ripe?
Thank you. Thank you very much for having me on this show. Indeed, I think I've been in this industry for a long, long time. And we've been talking about the importance and the depth that is required in the bond market. I think finally, thanks to all the efforts that you just mentioned coming together, all together, I think over the period of last few years, that bond markets are indeed increasing. But to my mind, I think that the real compelling regulation that our regulator SEBI brought out, I think, which has really propelled the bond market forward, is the OBPP regulations.
Sure.
Having come out with those OBPP regulations, we are seeing a proliferation of OBPP platform providers. So we have more than 40 of them in the country now, and we have partnered with many of them at NSDL. We've provided them digital experiences so that the entire process of onboarding is made available in a much more simplified and a convenient way. In addition to that, one of the other challenges that we've addressed, which is important for the retail investor, is information. So through our portal, NSDL India Bond Info, we provide a plethora of information about bonds, which really helps a retail investor to understand the risks and then take an informed decision. We also power the trade repository. The depositories power that. And through that trade repository, there is a plethora of, again, information pertaining to the yield, pricing, the quantum sold, so that this kind of information is also available, which is important for decision making. In addition to that, we have also introduced things like demat account validation, an online real-time service, which enables that the platform which is providing the sale or purchase of the bond is able to immediately access on a real-time basis the investor's demat account, confirm it, and so that the transactions could be put through. So I think a lot of facilitation, paperlessness, digitalization, information flow, I think all that has happened in the recent time. That's really propelling the retail participation to bigger heights. So a lot of effort has gone.
Oh, yeah, I can see that. You've been counting that. OBPs, 40 of them right now. With the kind of market that there is right now and the way it's opening and the kind of push that it has, do you see this number going higher?
Indeed. In fact, a few months back, it was 40. It's actually crossed 42 now. So, yeah, I mean, we've seen growth. We have seen not just growth of OBPPs, but I think their numbers are also now starting to increase. The amount of demat accounts, etc., that they open on a monthly run rate basis, I think that is also showing a healthier trend.
What is NSDL doing really in this regard when it comes to enhancing liquidity, or the fact that the way we have distribution models for mutual funds and insurances, which is quite easier, do you see that being replicated when it comes to bonds?
Yeah, I think what really has helped the mutual fund industry increase their distribution network are fundamentally 3 or 4 aspects. I think one is the digital experience, which has made things easy, paperless, and simple to operate. The second is the advisory network, which has come and brought the understanding of this to the retail investor. So these factors have really, and the smaller ticket size, I think combination of these factors has really helped the mutual fund industry. We are beginning to see some components of this coming into the bond market as well. Recently, SEBI has brought down the minimum investment from 1 lakh rupees to 10,000 rupees. I think that's a very positive step. There has also been growth of or involvement, I would say, of the advisors into this particular category of investment. So in addition to different other instruments, they're also talking about bonds as an important source of diversification. And the entire regulatory environment, interest rate environment is also conducive. So these factors, the information availability is also growing. So these factors which has helped mutual fund industry, we are seeing similar factors taking seed here. So I suppose that's already starting to show some benefits. And as this network and ecosystem matures a little more, I think more growth should be expected going forward.
Mr. Chandok, when you look at the kind of money that India raises from its debt market vis-a-vis bank is still very small in percentage. It is also very small in percentage when you compare it to other various developed countries or developing countries. What is it that you think India would need to do to push those 2 to 3 points to ensure that these markets start coming to the debt market in some more bigger way?
Yeah. So, you need the whole ecosystem to respond to an issuer. That's what helps the market grow. I just mentioned some of the components which have been laid out. So let me try and explain this with some numbers. 2 years back, we saw the total issuances of about 9 lakh crore. This has now gone up to, next year it went to 10. This year it's likely to be 11. So we are gradually seeing that as the ecosystem which supports bond markets is coming together, 9, 10, 11, that lakh crore. So that's the kind of growth we are seeing. I think more information will certainly help, because the terminologies associated with bonds is not so straightforward, for a retail investor. So that has to be demystified, explained to him. He needs to understand risks. He needs to understand the kind of impact interest rate movements can have on it, and so on and so forth. So these are not so straightforward concepts for him to grasp. So explanation is important. So as that maturity comes, understanding comes, information flow happens, I'm quite hopeful that that's going to also lead to some growth in the markets.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back. There was a recovery about 1 hour back in the markets, but now we're stalling around the 25,600 mark on the way up. facing a bit of resistance, and markets have gone sideways. Holding up in the green with a gain of about 0.4%, but you can see in the last half an hour or so, we've not managed to accrue any gains. Defense is a pack which is doing pretty well. The Nifty Defense Index is the top sectoral gainer, and in that, data patterns leading right from the front, 6.5%. You've got Paris Defense, Hindustan Aeronautics, BEL, BEML. That screen is buzzing and alive. But let's invite Ajit Mishra on the show now from Religare Broking. Ajit, thank you very much for joining in. Good rebound after yesterday's sharp sell-off. Do you see upward momentum? What's the trade?
Yeah, hi, good morning. So yes, it's been almost like 2 weeks that we are seeing this roller coaster ride continuing in the index. Means 25,400 on the downside and 26,000 on the higher side. So that's the range basically broadly that we are trading in. Yesterday we have seen after almost 3 days of advance, market retraced all the gains and we have retested the lower band, and again we are seeing a rebound attempt. So are we going to sustain those gains? It seems difficult considering that only banking is holding strong while the other sectors are not moving in tandem. So it's going to be more of a consolidation trend continuing in the index. So rather focusing on the index, the prudent approach is to focus more on banking index when it comes to the positioning on the index side, or stock specific approach. So basis that, the PSU banks looks comparatively stronger, and Canara Bank after this marginal consolidation is offering a fresh buying opportunity. So here you can go for long positions with 148 as a stop loss and 160 as a target. At the same time, since the tone is still consolidation, we are still getting opportunities on the short side also. So Dixon, after this recent consolidation or marginal uptick, we are again seeing there's a selling pressure emerging at the higher end, and in fact, it's a fresh breakdown from the consolidation range as well. So this may result in a gap that we have on the daily chart around 10,500 to be filled. So with that as a target, one can go short in Dixon even at current levels with 11,350 as a stop loss.
Okay, Ajit, so Dixon and Canara are the two names you gave us. Any play on, the AI trade, some of the names that have been gaining, and also this Pac Silica alliance that has been signed, GMDC, NALCO, and LC. Any opportunities there? Anything on your radar?
The GMDC definitely looks promising. Means it's been almost 2-3 months that the stock has been consolidating around its record highs. But every time we see that dip, it's largely maintaining its lower high, lower low structure. So this gives us confidence that eventually we might see a breakout above 620, 640 mark. So here, in fact, at current levels also, one can look for accumulation, considering that we have multiple supports around 540 levels. So here, definitely, you can go long with 640, 660 as a position target. At the same time, IT stocks, I still feel they're vulnerable for short-term volatility. And, for a time being now, if the view is short-term, one should refrain from any aggressive bets.
Thank you very much for joining in, Ajit. Get into a break. On the other side, we'll discuss market fundamentals. Nikunj Doshi, Managing Partner, CIO, PMS from Bay Capital Investment Advisors, joins in next.
Welcome back. You have the frontline index now crossing 25,600 as we speak, just a few points below the day's high. That's where you have it. The Bank Nifty again, trading with gains of almost 0.7%. Although, the advanced decline ratio, those crisscross lines converging a little, as we speak. But we'll see how it goes from here. But for now, the Nifty is above 25,600 as we speak. Let's bring in Nikunj Doshi, who's Managing Partner and CIO PMS from Bay Capital Investment Advisors, who is joining us now to discuss market fundamentals and his top sectoral picks. Nikunj, we're trading in, a pretty volatile global environment. The trade deal is behind. The FII flows seems to be trickling back in, but now there's this US-Iran tensions that are lingering, on the markets domestically. Earnings, we've seen some, strong shows by some of the big names. How are you placed here in terms of risk reward? Where do you see, for the Indian markets in the near to medium term?
Thanks for the opportunity. And just a correction, my name is Nikunj Doshi and not Joshi. I think you mentioned Joshi. Just on the markets, I think overall the earnings season has been good. Most of the companies reported good numbers. So top line growth has been good. There was some pressure on EBITDA because of the one-time labor cost, which most companies incurred. So overall, I think earnings-wise, we are seeing good positive trend going ahead. There's a capex picking up. And overall, we are seeing good trend in the earnings for FY27. As far as global flows are concerned, again, it's more dependent on geopolitical developments rather than anything else. And there, again, it's a fluid situation, so we can't take call on the global flows as of now. But if things stabilize, then we definitely see good flows coming in into the Indian markets. And overall, we are very, very positive for calendar year 26 for Indian markets.
Nikunj, in that case, what are the sectors where you're more bullish? You see a strong bottom-up fundamental, and what are the sectors where you would trim your position?
So, means we are focused mainly on four themes in the market. So, one is digitalization, second is consumerism, third is financialization, and fourth is outsourcing. And in all these areas, we have been focusing not for last 6 months, but last 10 years, I would say. We have been focusing on most of these themes. And I think most of these themes have played out. What we don't invest in is commodities because we can't predict commodities prices. We don't invest in real estate, infrastructure, which are capital intensive businesses. So as a investment philosophy, we focus mainly on capital light, asset light businesses with a good kind of earnings momentum possibility and leverage in earnings also.
Nikunj, hi, Reema here. I remember in the last conversation you said you're not very focused on traditional IT services.
Yeah.
You're more bullish on companies benefiting from AI adoption, where AI productivity gains will drive earnings for AI adopters. Something on those lines is what you had shared. Can you share some names of companies which would be big beneficiaries where we will see AI productivity benefits flow through?
So I think most of the manufacturing companies, see, like right now, what we are talking of IT services and IT related companies, but what we see main benefit coming is for the manufacturing companies using AI. So definitely these are the capital, I would say engineering companies or the manufacturing companies which are likely to benefit most from this AI adoption in terms of their operations and in terms of their productivity enhancement. So I think these are the sectors which are likely to benefit. For the IT as a space, I think any like development comes with opportunity as well as threats. And right now the market sentiment is such that it magnifies threats first. So for IT services, right now everybody is looking at what are the threats possible and ignoring the opportunities. Whereas in digital companies, digital first companies, we see that there's a lot of potential of productivity gains and efficiency gains. So take example like Ixigo, which is using AI in most productive way, or even car trade also means everybody is now concerned about what will happen with car trade as a business model. But I think they are using AI rather to support their operations than being threatened by the AI development. So I think these are the digital first companies which are likely to be mainly being beneficiaries of AI adoption.
Sorry, so Ixigo and car trade, are these stocks that you're recommending to your clients on the back of the same theme, AI beneficiaries?
As a disclaimer, means it's part of our portfolio investments. Both these stocks are part of our portfolio investments.
Okay, Nikunj, on the financial space, we've seen a massive rally in the PSU names. I mean, take the likes of SBI, stellar third quarter numbers in the last 6 months alone. It's up 40-45%. Some of the Bank of Baroda and other names also, Union Bank are up, anywhere in the range of double digit or more. Do you see a further rally from here for these PSU names? Because some of the foreign flows also seem to be adjusting away from their private peers, where the gap is narrowing into these PSUs. But do you see a headroom for further upside from here on, or what would trigger a re-rating?
So I think for banks, what most people look at is I would say growth in earnings, means NIM growth. And second is definitely their CASA ratios and other parameters which people look at. And PSUs, I think, are better placed in terms of CASA because of the client base that they have, as well as in terms of when the economy picks up and when capex cycle is triggered. These are the banks which have wider network to capitalize on that. So I think PSUs are benefiting from those kind of developments happening right now.
Yeah, I mean, they are showing an improved earning visibility, better ratios than some of their private peers. But Nikunj, any thoughts on the NBFC space as well? Any key themes, the trends you're seeing there? Any buying opportunities?
NBFCs are likely to mainly benefit from the cost advantage, means the reduction in their cost of liabilities. So I think that is going to percolate over next 6 to 9 months, I would say. And that's where their cost of borrowing will reduce and they'll be able to improve on their margins. And growth-wise, I don't see any issues with NBFCs in terms of the asset growth. And quality issue also, I think for most of the NBFCs is behind. And most of them have provided for the poor asset quality credits. So I think overall, NBFCs are also better placed in the whole financial system.
Quick word, you said you also like manufacturing and they could be beneficiaries of the AI productivity benefit. So digital first companies you spoke about, any in the pure play manufacturing side?
So again, engineering companies, I would say, capital goods companies, I would say are the better placed to take advantage of A, capex cycle picking up, and B, productivity gains and operating leverage, what they will have going forward. So any engineering or capital goods companies, I would say, are beneficiaries.
Thank you, Nikunj. Great chatting with you for joining in. By the way, the Nifty's hit that 25,600 mark, now trying to cross it. Bajaj Finance, Bharti Airtel, L&T. These are some stocks where you are seeing an up move in the last 10 minutes. Get into a break. We'll come back with more in the markets.
Welcome back, and here's a CNBC-TV18 mega exclusive from the AI Impact Summit in New Delhi. Anthropic CEO Dario Amodei says that we are not trying to replace existing industries or sell-off across software and the IT companies. Take a look at that and all the other comments he had to make.
The Indian IT services companies have taken a large knock, really on account of what Anthropic is doing with Claude. Now, are you a bad dream or a nightmare for the IT services companies?
We certainly don't want to be. I mean, the stock market can move for all sorts of reasons, but, I think our intent is that if companies work together with us in like a positive way, they can gain a lot and we can gain a lot as well, right? We're not trying to like replace replace existing industries. Like,
but can you? You're not trying to, but can you?
I mean, again, there's different ways things can go. And our hope is that we can work with these companies. We build models, we build products on top of those models, but also companies can further build on top of those products. They can distribute those products. They can, I think of it as Lego building blocks, right? Like, we're not saying like, okay, we put together a few Lego blocks and that replaces everything. We're saying, okay, here are a few Lego blocks and you can continue to build. You can continue to extend on them.
How much do you believe that we're likely to see an elimination? How much of it is going to be displacement? And how much of AI washing are we really seeing when we talk about job losses today?
Yeah, so, I think it's really hard to predict. The economy and economics is hard to predict. So it's hard to say, will jobs go away or will they be downskilled or will they be moved in kind of a different direction? So the exact form that it takes, I don't know. What I do know is there will be potentially a lot of disruption because the technology is moving so fast. What is different about AI than previous technologies, it's not any different in that, there's some things humans could do before that, this new technology is now able to do, that's able to replace parts of it or all of it. What's different is it's moving quickly and it's broad because AI is a general technology. And so what we need to do, I think, more so than trying to figure out exactly what form the disruption will take, is help people to adapt. I will give an example. I can see I can see the day when even within, say, Anthropic, we need less software engineers than we have today, because the models are better at automating software engineering end to end. But we've been thinking hard about, what are jobs that those people could do? And, one thing is, there's this notion of the forward deployed engineer, someone who has technical skills, but who works with customers to enable technical systems and technical solutions with those customers. And as Anthropic grows and has more customers, there's going to be a need for a lot of them because the number of customers we need to talk to is large. And so that's one possible example where one thing goes away, but another door opens to take its place. And, I can't guarantee that more jobs will be created than are destroyed. We have to make that true. We have to figure out how to make that true, and it's going to be a challenge, but the earlier we see it, the more we're honest about it, the better the chance we can address it.
The possibility of Anthropic being blacklisted by the Pentagon, have you been in conversation with the authorities there? Is there an update on that you can share with us?
So we've been deploying our models for U.S. national security for quite a while, and I think our basic position on it is we've offered the models in kind of a very wide range of for a very wide range of use cases, and I think the main areas of concern that we have are fully autonomous weapons where there isn't a human in the loop, and domestic mass surveillance of Americans. So those are the two areas where we have some concern, and we want to make sure the models are not used in that way. And we continue to have productive discussions about how to use our models for almost every use case. But while taking into account, I think these red lines are fairly important for making sure that AI is used in a way that's compatible with democracy and in line with the culture of our company. We're just attempting to make sure that we deploy our technology in a way that's compatible with and advances democratic values. The whole point is to defend democracy, and we continue to have productive discussions around this, and we're very excited to help national security of the United States and other democracies.
What an interesting conversation there, and it's all about AI, data centers, and where we're headed in terms of intelligence. I just want to quickly talk about Reliance Industries. That's up 1%. And this is the Morgan Stanley note. They say that Reliance Industries has pivoted every decade in its 48 years of listed history, and now they plan to invest 10 lakh crore rupees, that's $110 billion in AI, energy-related supply, and the entire digital ecosystem over the next 7 years. And this marks the next shift in their capital allocation. And Morgan says that their proposed investments, that's 10 lakh crore rupee, is as large as their telecom and consumer investments through 2014 to 2021. Morgan Stanley says that they see the company taking a partnership approach because the scale is massive. As I said, it's on par with what the company spent to build the entire mobile network and the retail stores over the last decade. And the money will not be just for software. It will include building massive data centers, making their own AI chips, creating renewable energy to run those power-hungry systems, and spending on AI chips. As Mukesh Ambani said yesterday, Reliance Industries will begin with a 120 megawatt of capacity in the second half of this year. Work is already ongoing in Jamnagar. The other big question is on where will the capital come from this big investment? Will it suppress the free cash flows and the ratios? Now, Morgan argues that the company generates about $14 to $15 billion in cash every year from the existing businesses. But given its existing investment requirement, they believe the company will need to sell off parts of their other businesses like telecom fiber network to raise an extra $4 to $5 billion a year. Why is Morgan Stanley excited on Reliance Industries? Because they believe the intelligence business will be more profitable than their older investments, potentially earning double the return. That's 12% ROCE, which is why they have an outperform rating, target price, top pick, and a target price of 1803. Get into a break. We'll come back with more in the markets.
Welcome back. Let's get you a quick check of the macro signals from the day. The markets, by the way, the Nifty is just below the 25,600 mark as we speak. It's been a bit of a volatile day, but, still up about 130 points. Bank Nifty, though, that's outperforming the markets. It's up about 0.7%, while the broader markets as well, for the mid-cap, it's up about 0.4%, and the small cap also in the green as we speak. Now, the benchmark 10-year government bond yield, that's trading around 6.7% today, and it's higher by 3 basis points. Remember, the bond markets were closed yesterday. Today, again, the yields are higher despite that recent debt switch operation we saw from the government, because traders believe the further measures to cool these yields from here are unlikely and rare. Now, the rupee, that opened weaker today on the back of a stronger dollar. The dollar itself has been gaining strength because of the good U.S. economic data that we got, including a drop in the jobless claims as well. Now you have the rupee trading about 90.3 to the dollar. That's where it's at. But, these escalating geopolitical tensions that's been affecting the markets between the U.S. and Iran, they've also driven investors towards the safe haven assets like the dollar, while also at the same time pushing the global crude prices to a near 6 to 7 month high. Oil prices up 5% this week, 15% this year so far, and you have the Brent crude now above $72 to the barrel mark, and that's tracking the rising tensions between the US and Iran. That's feeding back into this prices. The NYMEX also at 66.83 as we speak. So that's the macro setup as we bid goodbye on Trading Hour.
Well, thank you very much for watching. Don't go anywhere. On the other side is Halftime Report.